All right, welcome. Today, we're going to jump right into the very first, and I mean the most fundamental step in any accounting system, the books of original entry. This is really where the financial story of a business begins, literally one transaction at a time. So, here's what we've got lined up. We're going to follow a transaction on its entire journey. We'll start at its first stop, the day books. Then we'll take a really deep dive into the cash book because it's so important. After that, we'll see how everything gets organized in the main ledgers, and then we'll put it all to the test with a real exam question. Okay, let's get started. We're kicking things off with the absolute basics. Every single complex financial statement you'll ever see, it all boils down to one simple event. A sale, a purchase, paying a bill. Our job as bookkeepers is to catch that moment and turn it into a proper financial record. So what you're looking at here is the whole accounting cycle, from start to finish. It's a really logical process, kind of like an assembly line that takes raw events and turns them into useful reports. And while every single step is important, today we are zeroing in on step 3, the day books. This is the first, and I mean crucial, recording of every single transaction. Okay, but wait. Before we can write anything down, we need proof. Seriously, think of yourself as a detective at a crime scene. You can't just make stuff up, right? You need evidence. And in accounting, our evidence is what we call a source document. It's the official paper trail, the smoking gun that proves a transaction actually happened. Now, what's really cool is that each one of these documents tells a different part of the business's story. An invoice? That screams sale on credit. A receipt? That's your solid proof that cash just changed hands. A credit note tells you a customer brought something back. So you see, these aren't just random scraps of paper. Nope, they are the absolute fundamental building blocks for everything we're about to do. Okay, so now that we have our evidence, let's see how we use these source documents to manage what can feel like a daily flood of business transactions. They get sorted into these special books called day books. Now, this next point is super important, so lean in. Most day books are just organized lists. They are not part of the formal double entry system, not yet anyway. Their one and only job is to sort the chaos. Can you imagine trying to find all your credit sales from a giant, messy pile of invoices and receipts? It would be a nightmare. Daybooks are what prevent that headache. They group everything neatly right from the get-go. This table right here shows that sorting system in action. See, we've got a specific book for credit sales, another for credit purchases. You get the idea. But hang on, have you noticed something? The top 4 are all for credit transactions. Why is that? Well, it's because cash transactions are handled in a totally different, very special book, which we're going to get to in just a minute. So you might be wondering, what about all the other stuff? The transactions that aren't your everyday credit sales or purchases? Well, they have a home too. They go into the general journal. The best way to think about it is like the everything else drawer in your kitchen. It's for all the infrequent but still really important things, like recording depreciation or fixing a mistake. Okay. It's time to talk about the most unique, most special book of them all, the cash book. This thing is a total hybrid. It's a book of original entry for sure, but it's also a proper ledger account. It's playing on both teams. Look, if you only remember one thing from this entire section, please make it this. The cash book is the only book of original entry that's also part of the double entry system. This is huge. It means that unlike those other simple lists we just talked about, every single entry in the cash book has to follow the formal rules of accounting, debits and credits for every single cash and bank transaction. All right, let's clear something up that trips up a lot of students. The difference between a trade discount and a cash discount. A trade discount is for buying in bulk. Think of it as the invisible discount. Why? Because it never even makes it into the accounting books. You just record the final lower price. But a cash discount, that's for paying early, and it's very, very visible. It happens right at the moment of payment, and you absolutely have to record it in the cash book. Next up, contra entry. I know, it sounds super technical and complicated, but trust me, it's not. A contra entry is just the business moving money around. It's taking cash from the cash register and putting it into the bank account, or vice versa. It's exactly like taking a $20 bill from your left pocket and putting it in your right pocket. Has the total amount of money you have changed? Nope. And that's why it gets recorded on both sides of the cash book, to show the movement, but also to show it cancels itself out. Okay, quick recap. We've sorted all our transactions into daybooks. What's next? Well, now it's time to transfer or post all that lovely organized information into the ledgers. And the ledgers? Think of them as the main permanent database for every piece of financial info the company has. I like this analogy. If the daybooks are your rough notes you scribble down during the day, then the ledgers are the final, beautifully organized chapters of the accounting story. Every single transaction, whether it's sales, rent, or a payment from a specific customer, finds its permanent home right here, in its own dedicated ledger account. Now, to keep all this information from becoming a giant mess, the ledgers are split into three main sections. The easiest way to think of it is like folders on your computer. You've got the sales ledger, which is a folder for all your customer accounts. You've got the purchases ledger for all your supplier accounts. And then you have the general ledger, which is basically the folder for absolutely everything else. All right, theory's done. Let's get our hands dirty and apply all this to a typical O-level exam question. And listen, the key here isn't about being fast. It's about being methodical and accurate. We're going to build a 3-column cash book, step by step. Okay, so here's our scenario. We're working with a business owner named Shahid. Let's take a close look at these transactions. We're starting with a little bit of cash on hand, but a bank overdraft. Ouch. Then we've got a bounced check, a payment for some private fuel, we'll have to watch that one, a customer payment that includes a discount, some straightforward cash sales, and finally, a deposit into the bank. Let's break these down one by one. All right, let's walk through the solution together. First things first, August 1st, we put in our opening balances. Notice the $50 cash is on the debit side because it's money we have. But that bank overdraft, that's a liability, so it goes on the credit side. Okay, August 9th, the dishonored check. Now this is tricky. We thought we had the money, but the check bounced. So now we have to treat it like money leaving our bank account. That means a credit of $362 in the bank column. Make sense? Good. Next, August 18th. Paying for private fuel with business money is always drawings. It's a payment out of the bank, so we credit the bank column for $54. August 24th, we get paid by Mariam. The discount is 2.5% of $520, which is $13. That goes in our discount allowed column. The rest, $507, is money coming into the bank, so that's a debit. August 30th, nice and easy. Cash sales of $3,224 is money in, so we debit the cash column. And finally, that contra entry on the 31st. We're banking all our cash except for $100. So, if we had $3,274 in cash, we're moving $3,174. That's money out of the cash column, a credit, and money into the bank column, a debit. Okay, we've got all the entries in, now for the final piece of the puzzle, balancing the accounts. We just need to total up both sides. For the cash column, the debit side is bigger, so our balancing figure of $100, the cash we kept, goes on the credit side. For the bank column, it's the other way around, the credit side is bigger. The total credits are $7,567. We subtract the debits from that, and the difference, our new closing overdraft, is $3,815. This balance carried down then gets brought down to the opposite side to kick off September. And hey, look at that. Shahid's overdraft actually went down a bit. Good for him. All right, to wrap things up, let's do a super quick rundown of the most critical points. You really want to get these locked in for your exam. Honestly, getting these fundamentals right is the whole key to success. So, let's recap the essentials. Remember, each transaction has its own specific daybook. The cash book is the special one. It's both a daybook and a ledger, part of the double entry system. And the discount rule. Trade discount is invisible, deducted before you record anything, while the cash discount gets recorded in the cash book. The general journal is your catch-all for anything non-routine. And never forget, source documents are the proof for everything. Finally, it's the totals from the daybooks that get posted, not every single little entry. Master these rules, the absolute grammar of bookkeeping, and you'll have a super strong foundation. So we've laid a really solid foundation today. But I want to leave you with this final thought to chew on. How do you think one tiny error made right here at the very beginning, in the first book, how might that affect the final financial statements? The truth is, it creates a massive domino effect. A mistake made here doesn't just stay here. It travels through the whole system, corrupting every single step that comes after it. And that's why, in accounting, getting it right from day one, well, it isn't just important, it's everything.